Good morning and welcome to the Killik & Co market update. This week, the Bank of England has cut interest rates from 5.25% down to 5%. The bank had been widely expected to cut interest rates at some point this year, and ahead of this meeting, the market was implying there was a 60% probability of rates being cut at this particular meeting. On the day of the rate cut, we did see a positive performance from shares in sectors that would be expected to benefit from lower interest rates, one example being house builders and property. This chart shows the iShares UK Property ETF, and you can see it performed poorly from 2021 onwards as interest rates rose, but it has been picking up this year in anticipation of rates starting to come down again. Labour's plans to increase house building may well have had a positive impact too. On the other hand, we saw a negative performance from companies in sectors that would not be expected to benefit from lower interest rates, banks being the main example. When interest rates are lower, banks cannot charge as much on their loans. We saw some fairly sizable moves in the banking sector on Thursday. Lloyds closed down 5.74%, NatWest, formerly RBS, down 8.07%, Barclays down 4.66%, and HSBC down 6.46%. The Federal Reserve over in the US also met this week and opted not to lower interest rates at this time. But in the press conference later in the day, the chairman Jerome Powell did imply that a rate cut in September is still very much on the table. In other interest rate news, Japan has raised its interest rate for only the second time in 17 years, with the first hike taking place earlier this year. The interest rate hike has had quite an impact on the Japanese currency and the stock market. Here's the pound against the yen over the last year. The yen has been weakening against the pound for most of the year, but look at that turnaround in the last month. Holding the yen has become more attractive now that rates in Japan have gone up. Or in other words, holding the yen has become less unattractive now that interest rates are no longer in negative territory. Demand for the yen has therefore increased and the currency has strengthened. The pound, meanwhile, will likely become less attractive now that our interest rates are on the way down. The stronger yen has had a negative impact on the Nikkei 225 index. As you can see, the index has followed an inverse trajectory to the currency. It's been on the rise for most of this year, but it has dropped this month. The Nikkei 225 contains lots of big exporters such as Honda and Toyota, and Fast Retailing, which owns Uniqlo. When the yen is weak, these exports seem cheaper to overseas buyers and demand increases. When the yen is stronger, the exports seem more expensive and demand may fall. The Japanese stock market is still an important one on the world stage. Here's the current country breakdown of the MSCI World Index. The US now accounts for a massive 72%. Japan is in second place with 5.7%, and the UK is far behind Japan with a weighting of just 3.7%. And finally, it's been a big week for big tech companies this week. Investors were a bit disappointed with results from Amazon and Microsoft, partly due to the big capital expenditures that both companies are having to undertake to keep up with demand for artificial intelligence. Do bear in mind that shares in both companies have come up a lot this year, so despite some weakness in the past week, they have both still generated very strong returns. Investors were happy with Meta's results, with shares rising over 5% when the earnings were published. The shares are now up over 40% year to date, and we've had a few questions about whether they're now expensive. On a price-to-earnings basis, where we compare the share price to the amount of profit the company is making, the shares are actually less expensive than they were back in 2019. Here's the share price over 5 years. They were below $200 in 2019, and they're now close to $500. This chart shows the price-to-earnings ratio. Back in 2019, it was 32.8, and it's now less than 30. The shares may have gone up a lot in the last 5 years, but profits have grown so much that the shares are now technically cheaper. Please do give us a call if you'd like to discuss this in more detail. Next week, we'll have some insight from the travel sector with results due out from Airbnb and Walt Disney. That's it from us. Have a great weekend, and we'll see you next Friday.